probably have one or two more, but they can come. All right, so today's class is on corporate credit ratings, okay? So just off the top of your head, when do you think this would come into play and how is it important for commercial real estate?
Net lease of investments.
Okay? Big in net lease, what else?
Well, the sale of property, when you're looking at the tenants, the creditworthiness of the tenants makes a big difference in terms of, how you value the real estate.
Or when getting loans.
Right, okay. So it's almost just like credit reports for individual, but this is for companies. And then it goes by different grades, and the big investment grade companies, the hedge funds, the pension funds, they only want to be in the top rated companies, and because it's just less risk for them, okay? So let's just talk a little bit about, all right, so Mark's deal with that, the medical office in Chicago, okay? That company, Healthcare Trust of America, they have a credit rating, okay? And because they're in such a stable industry, that helps them with a higher credit rating, which means when they can borrow cheaper interest rate than other companies, okay, which gives them a competitive advantage when they're in the marketplace. There are some companies that their credit rating, also called their bond rating, is safer than some government bonds, okay? Some companies have that, all right? All right, so let's start with just one example, because when I did net lease, credit was a big thing, especially would make a property in the middle of Kansas very attractive where the ground might be worth $5,000, but you put a Chick-fil-A on it with a corporate back guarantee, 20-year lease from Chick-fil-A, all of a sudden you got a $4 million property, okay? But it's not the property, it's the lease backed by a company like Chick-fil-A, okay? So there were times that it had to be the corporate guarantee. The franchise guarantee was something, but it wasn't as much. But now some of these franchises are better run and have better credit ratings than the corporations. There's one BK franchisee that he has 800 units, okay? So there's because a lot of these big companies don't want to deal with thousands of smaller operators. So they're dealing with operators that some of the franchisees are publicly traded companies. And they don't just have, like this same guy that has 800 Burger Kings, he's also got like 500 Sonics, okay? So some of these franchise owners are huge. So don't discount a franchise owner right off the bat like back in the day they used to. All right, so let's kind of do a little bit of background on this just so you have a little bit more. What are the 3 big corporate rating agencies that are out there?
See, there's Standard & Poor's, Moody's, and I'm not sure the third.
The third is not that big, but they call them the big 3, but it's really 2.5. Okay, Moody's, Standard & Poor's, and Fitch control 95% of the market, okay? Moody's and Standard & Poor's each have 40% of the market, and Fitch has about 15%. Their status is cemented by law, first in the United States, but also in Europe, because they are the only NRS ROs, which stands for Nationally Recognized Statistical Rating Organizations, meaning that they're used by U.S. government in several regulatory areas. So just think SEC, FTC, all these government agencies, they have to rely on outside sources when they're rating companies and things, and so these are actually recognized by the government. So it's like, that's pretty, solid. But after the crash of 2010, all of these credit rating agencies took a big hit on their image because a lot of them were very slow to downgrade companies, and it also came about that a lot of them were like in bed with like Lehman, getting payoffs and all those kind of things. They still have an important standing, but it's not like it was before the crash, okay? So there's a lot of startups that are trying to compete against them, but these are still the three ones that you gotta, pay attention to. All right, so it looks like we're about to have someone join our class, so I'll let him get in and get settled before I start back into my next piece.
Ticket?
Come on.
12 sharp.
You gotta be in the corner.
Yes, I deserve it.
So we pretty much just went over what the big three rating agencies are. Do you know what they are for corporate credit?
No.
You get put on the spot when you're late. But it's basically Standard & Poor's, S&P, Moody's, and Fitch. They're the ones that do credit ratings for all the company, and they're recognized by the governments. So they're very important what their ratings are on company credit, okay? And credit is important because that's how much they can borrow at lower prices and those kind of things, okay? All right, so there are dozens of other credit rating agencies, but they're not recognized like the big three. And so most companies and most stock brokerages, they're not gonna list those or even use those. They use these because that's the standard. Hey, all right, so let's,
Is this the end of it?
huh?
Is this the end of it?
Just the beginning.
Oh, okay.
We gotta find a chair for you, so,
Yeah, take this
All right.
one.
I'm gonna have one.
Sorry for coming
okay. I wanna have full class, but we need to get going right at 12, okay? So.
in. Okay.
All right.
No more people after this.
I think there is one more.
There is?
Yeah. But, I will make them stand. They can stand right there.
Yeah.
Or there's a seat right there in the windowsill.
Oh, well, not for everybody.
Right.
That's the nicest way to put that.
Okay. All right, so now that we know who's the one that actually do the ratings and a little bit about why they're important, let's talk a little bit about what is a corporate credit rating and why it is really important, okay? And this is to both a buyer, a tenant, a seller. All of this is important when you're dealing with these type of properties. And these are not the typical mom and pop private investor type of properties, okay? So it's definitely a tenant that's with a larger company. It's definitely, bigger operators that this would come into play. All right, so a credit rating company helps investors decide how risky it is to invest money in a certain country or security by providing independent, objective assessments on the creditworthiness of companies and countries. So a lot of these, it's basically companies that, someone's thinking about investing in Apple or another company, and that's why their credit rating would be on there. We're not going to use it for that. We're going to use it based on how much they can borrow at what discounted rates, and if they're a tenant, how credit worthy they are. For somebody that's a little bit smaller than these companies, but still have a decent track record in like a local or regional business, what's another credit type company that would come into play? Old name. That would be like checking a business's credit, but not actually like a corporate rating like Moody's or S&P does.
There's some better
Maybe
business.
Dun and Bradstreet.
Dun and Bradstreet, right. Yeah, and they sometimes call it the D&B. Dun and Bradstreet is kind of been passed up, but there is another source that a lot of companies use also called LexisNexis. And that was started by attorneys, and it's still supposed to be used by attorneys. In fact, at my old company, we got in trouble because we used to use LexisNexis to actually research our clients, and you're not allowed to do that. But we would use it to like try to dig into their financials and like, yeah. There is another Clear. You know more about that, but it's actually run by the government, but some companies are using that now too. So why don't you tell them a little bit about Clear, because you know a lot
Yeah,
about
so
it.
Thomas Reuters Clear is a competitor to LexisNexis. It will do governments use it for background checks. Other employers will use it for background information as well. Clear is actually being pushed out to entertainment locations such as stadiums, and those are going to be the new metal detectors that you walk through, and you might have to thumbprint coming up in 2021, I think it is, to get into sports arenas.
Wow,
Yeah.
that's very interesting.
So there's lots of data out there, but companies are just like individuals where basically everyone has a history and a track record, and everyone has a score, like a FICO score, a Dun & Bradstreet rating, or a Moody's or S&P, okay? We have another visitor. So let's, maybe we can, maybe, Jordan, maybe you can like put that chair there, we can wheel one more chair in.
We don't have to worry about that.
And no, we'll find you a chair. We can get you a chair, you can sit right there.
Sure, should I do
So you want me to grab one?
Yeah, that would be good.
Steal this one.
No, it's okay, it's okay.
Thank you.
Actually, this would be a good time for you to introduce yourself. This is gonna be our newest team member to Peak Commercial.
Hi everyone, my name is Josue Rosa. I have a background in residential real estate and looking to join the team on the multifamily focus.
He's done some multifamily with his.
I have definitely done a few multifamily, helped my family with the management of theirs. And you may know my wife, right?
They probably don't, but I do.
Okay, there you go.
His wife is our director of property management upstairs, so she runs the owner's whole portfolio nationwide of retail, multifamily, you know, so yeah, so she's definitely a valued member of our family, so we've been working on her to get him over here, so.
Yeah, so,
welcome.
thank you. It's nice to meet all of you. Hopefully get to know you a little bit better soon.
Yeah, absolutely.
All right.
Yeah.
And sorry to interrupt halfway
No,
through.
I was gonna make whoever came in late stand, but you dressed so nice, you got to slide.
Thank you.
Okay. In fact, I don't even have a jacket on, I
You can
feel.
borrow mine if you want to talk.
Right. Okay, all right, so, all right, just a quick recap. Standard & Poor, Moody's, and Fitch are the three big credit agencies that rate companies. They are recognized by the US government. The larger investors, hedge funds, larger companies, and pension funds, they are rated, and their rating will determine what they can borrow money at. So, all right, so let's go more into how they determine their ratings, and then we'll go into how do you search these companies, and maybe we'll know a few companies. Let's see. Okay, so we talked about sometimes some of these franchises. There's a Burger King franchise that has 800 units. There are times that their corporate rating is better than the main corporation. But then there's some corporations like Chick-fil-A, Whataburger, Whole Foods, where in net lease, they were the gold standard. And if you could get those, you'd have 20 investors. We had companies, anybody ever heard of Hobby Lobby? One Hobby Lobby, we'd have 50 people trying to buy it, especially evangelicals, because they love the way the company is. Evangelicals love Chick-fil-A too, that's why they're closing. So there's some companies that, you know, if you have an In-N-Out, that's a gold mine. You're gonna sell that thing quick and at high dollar, and you're gonna have a lot of people after it, okay? So, but they also have, if you have a corporate backed lease by Chick-fil-A, by Whole Foods, by one of those companies, That's what makes it valuable, okay? And their corporate rating is decided by these three companies, and there's a bunch of things that go into that. But what are the assets? We already talked about net lease and QSR, which is fast food. What other asset classes would mainly be involved with the corporate credit ratings?
Office.
Office. Class A office. Class A office, okay? What else?
Maybe industrial,
Mm-hmm.
depending on who the,
Yeah. But it's gonna be the nicer properties and the bigger players that this is gonna come into play. Okay. Why is the corporate credit rating important to buyers, sellers, or tenants, or landlords?
You mentioned earlier, it's all about risk.
Right. Risk, how much you're gonna pay for their money. Like landlords, okay? A landlord has a great property. They will decide who they want to tenant that, okay? Sometimes they don't want local, sometimes they don't even want regional. They only want national names, okay? So you go in there and you are representing a buyer who's got a new company for juice. They don't want to hear from you, okay? They want Jamba Juice because they think Jamba Juice is going to help them to attract other like-sized tenants and bring in more traffic. So it's like, you got Joe's sandwich shop, they don't want you. So you might be better off advising your client to, it can cost them $100,000 to set up this company. Maybe for a little more or even the same, he can buy a Subway or a Jersey Mike's franchise and have a better chance to get in better locations. Okay, because especially if they are able in certain locations, because the corporation will back the leases in certain locations. Why would they do that? Especially if it's like a new operator. Why would the corporation be willing to do a corporate backed lease for some?
They want the location themselves, they want that
Yeah.
exposure.
A franchisee can go under, they don't care. If it's a good location, they will make it a company operation or just put another franchisee in, okay? So, all right. Okay, so this might be interesting to do now before we go into the nuts and bolts on how they do this. Name one or two or three companies you think that are AAA rated, which is the highest in most of these rating agencies.
let's go with Apple.
Who else?
Certain banks, I don't know specifically, but there's certain banks that wouldn't be Wells Fargo anymore. At one time there might have been, but.
Wells did used to be
Yeah,
that.
not anymore, but, or at least not currently, I don't think, but.
Okay.
Probably B of A is still up there, or Chase, I suspect.
Chase.
What about the ones you mentioned, Chick-fil-A, In-N-Out? Would they be up there?
I'm sure that, you would have stores like, CVS or Walmart. Those stores are gonna probably still be in that category.
Walgreens. Actually, is Walgreens getting bought out by?
Walgreens is bought out by, no,
CVS.
I think it was CVS, right?
Rite Aid, I know, was acquired by,
Hospital. They just did a deal with their, the Valencia Town Center. They took over the Sears.
Okay.
Toys R Us.
This one I know of, this one I know, and this one is private, but it's just as good as AAA. So they have other ways to rate private companies, but they're not rated the exact same way, but In-N-Out is gold standard in
I'm pretty sure
QSR.
Amazon will be up there.
What's that?
I suspect Amazon would be on your list.
Um,
No?
Amazon,
Has to be AAA rating.
Hey, even though they're traded.
No? Okay.
I think Amazon is right below, but they're not AAA only because they don't care as much about showing profit because he owns all the stock. So they reinvest so much in new technology that their profit is much lower than it could be. They've all, so yeah, so I can't look up because I didn't think it through that I can't go and show you guys the things on my phone, but the places that you use and that, you know, I can explain to you, one, Bloomberg is one, okay? If you go on Bloomberg, you go and check any of the stocks, it'll have their credit rating. But I specifically have Moody's downloaded and Standard & Poor, but with Moody's, it's really easy. You just like go to moodys.com and it has a tab for checking companies. You just put in the name of the company and it'll come up. And Apple definitely is AAA. I know CBS is. B of A was, it's not now because of debt. Costco is, Walmart definitely always is AAA or AA. So yeah, it's actually the company that is, there was a time when there were only 2 US companies that were still AAA, and Microsoft was one and still is one. But Apple, one of their huge thing is they have so much cash on hand that it's, you know, you have no worry about them paying their debts for 20 years with like the 160 billion they have just in like, you know, in savings. So, yeah, so you guys get the picture. You kind of know the companies that, you know, it's not only because they're large, but it's because they're constantly profitable. They, you know, don't take a lot of risks. They have the prime locations. They have almost, I mean, Amazon, for all intents and purposes, is AAA rated, but it's like they're very aggressive on their research and development. They don't have the type of board where they have to be careful with showing, you know, certain stock increases in profits in certain quarters. And they're buying companies like crazy. You guys heard of PillPack? They bought that.
Wow.
So it's like now, it's like, so when they want to go into another sector, they just buy like a market segment leader and then just like go into it. So now, at first it was kind of quiet because they didn't, you know, now it's like all the commercials say an Amazon company when they're pitching PillPack on TV. So it's like, there's not any kind of sector that I don't think they can really dominate. Because even Whole Foods, which was a great name, now they have like agreements with the owner of a bunch of these dark Kmarts and Sears that they have the first shot to go in there and make them Whole Foods or make them Amazon distribution centers. So it's like, you know, they were considering buying Barnes & Noble. I mean, they're the ones that put Barnes & Noble like almost out of business, and now they're just going to be able to go buy the name and all the rest of the customer list, whatever, right before they kill them. So it's like almost like, yeah,
It's kind of ruthless.
yeah, it's crazy.
I'm wondering about them getting into the logistics game too, because you know they just put out FedEx, and for FedEx, I guess it wasn't a big loss. It was like what 2% or less of their revenue.
Yeah.
But I still think they're gonna be able to set up that kind of platform to where they can take over that soon.
And you know, another area that they're making tens of billions is data storage. So they have to have all these data storage places out in the middle of the desert that are air conditioned and bomb proof, whatever. But they sell a lot of their storage space to other companies. Not only the small companies that sell on Amazon, which, you know, they could just like take that same product and they put theirs above. So I mean, they even scam with their own resellers.
Amazon's choice.
Right. So it's like, but data storage is like a huge part of their business now, where they're selling like data and cloud space to all kind of companies. They're making like so much money off of that. Okay, so as we go more into this, let's see a little bit more about some of the things which we talked about, but it's basically long-term and short-term debt, profitability are some of the main things they look at for the ratings. And it's very important for banks, insurance companies, and other investors because they go by these ratings to decide, what the interest rate that they're going to pay. Ratings are not equal, and they measure an entity's ability and willingness to repay debt. Okay, so the highest is AAA, and the lowest, which is considered a junk rating, is a D, which is considered junk, okay? So there's lots of companies, there's, okay, so AAA is the highest, and then AA, and then A. So, AA and A are still good. They're still considered investment grade and low risk, okay? The lowest that you can go for investment grade, which is, investment grade is more like the REITs, pension funds, hedge funds, sovereign. What's a sovereign fund?
Basically, that's like a government fund.
Saudi Arabia, Emirates, okay, so, yeah. Like the United States, we don't have that. Our companies do but some of the smaller countries where, it's like one family will run most of the country, it's like they have these sovereign investment funds where basically Saudi Arabia knows that the oil is not going to be a long-term thing, so now they're taking all that money they've been making in oil and they're buying hotels and they're buying chains of restaurants and they're buying properties and they're buying things all over the world, and it's through a sovereign fund, a sovereign wealth fund. They call it a few different things, but sovereign always means it's like a government, but it's usually a government that's like Omar and Kuwait and those type of countries. Yeah, Kazakhstan. It's usually countries that it's like just a small one guy or families run things. Okay. All right. So
You were saying that the lowest grade that would be in still investment is what?
B, triple B.
Triple B.
Yeah. Anything below that is considered junk, and these funds, they will not deal with those companies. So as soon as a company drops to double B or lower, they lose a lot of these. There's a lot of these investment. They don't have traders like they used to. They use like algorithms, and so they have this programmed into their computers, and they make thousands of trades based, sometimes just on 1 or 2 cents. But if you're doing millions of shares, it makes money. But they're programmed in that something that goes below double B, they're not interested anymore. So that takes a lot of buyers out of the system. Okay, so the credit ratings are very important for most of these large companies. I mean, Amazon, it wouldn't matter as much because he owns, well, now his ex-wife owns a big part, but he owns still like 60-80% of the stock. So even though there's lots of people that own Amazon stock, he still controls it. So he's not going to care as much, but most companies do. Okay. All right. So there are, okay, so here's, you guys are going to have these handouts. 2 minutes? Okay, so you guys are going to have these handouts, and it talks a lot more detail about the sovereign credit ratings, and it also talks about a lot of the controversies that have happened since the crash, and the Dodd-Frank rules have changed a lot because Moody's and S&P, they're not allowed to be like getting, trips and dinners from these from Lehman Brothers and all that crap, because that's what was happening, and that's why they didn't downgrade a lot of the companies and a lot of AIG and all that, because they're winding and dining them. So there has to be a lot of separation now between the credit agencies and the companies that they grade. Okay, So you guys will get a lot more, details on that. We'll have it up. I think it's probably gonna be on Dropbox.
It's already there.
All right, so any questions about this? Okay, so just one more reminder is we're really getting close on the website, so we wanna make sure you guys have good pictures, tied and suited up, and we're gonna be having a round of new pictures, so if you haven't had them done, make sure you get with Will so we can get you guys in here. You're ready to go right now, but we need to get you guys bios so that we're all set up. And one thing about his wife is that we've set up the, this has nothing to do with you, but you're here, so, okay. We're doing the property and asset management, okay? So we decided that would be easier, that we don't need you guys, or we don't expect you guys to sell the property and asset management services, okay? So we're gonna have a page on the website, and we're gonna be telling you guys more and more about it. But if you have somebody, an existing client, or you have a client that you're gonna be selling a building, we don't want you guys to have to worry about pitching that. You just let them know we have it, and then myself or Gigi will be in the meeting with you, and we'll pitch the property management services for you to help you get the deal. And if you get the property management deal, you get a percentage of the first month fees, and you'll get 5 to 10%, depending on the size of the building, for every month that they are managed by Peak, okay? So 5 years that they're under management, you get something every month for that. And then 5 years later, when they decide they wanna resell, that property goes back to you to sell it again. So you always stay in the property as long as you're still with Peak, okay? So you guys don't need to worry about what we charge and what we do. It's like, just have us sit in the meeting with you. We'll pitch the asset and property management services, and you guys just worry about the buying or selling of the building itself, but you'll still get a piece if we get the property management, okay? All right, any questions about anything? Thanks for coming in. Good group today.
Thank you.